As you can see, this is the purpose of our project, which is to enhance our understanding of the application and disclosure of these topics. In order to finish the project, we assess and analyze the company's financial statements for the year 2020 and 2021.
Assalamualaikum and hi, my name is Nurul Ain binti Omar. My matric number is 288-712. I will present for the company Oli Corporation Berhad. Background of the company for Oli Corporation Berhad, it was successfully listed at the Kuala Lumpur on 23 April 2002. The group is leading manufacturer and distributor of steel cable support system, cable management system, integrated shielding system and LED product in Malaysia.
Harbour Link Group Berhad is a company that was established in 2002 and officially listed on the main market of Bursa Malaysia Securities on January 6, 2004. The company's roots have been firmly established in the shipping, marine integrated logistics, engineering, and construction industries. The company has effectively established itself as a renowned brand name within the industries it operates in, and its business footprint now spans the intra-Asian region.
Assalamualaikum and hi, my name is Nurul Afizahani binti Rosli and my matric number is 284309. I'll present about the background of Messiniaga Berhad. Messiniaga Berhad was established on 17 December 1981 and has been in the technology business longer than 3 decades. Along with the government's goal to boost local involvement in the technology sector, since then, Messiniaga has spent over 40 years working in the IT industry with a paid-up capital of 60.4 million ringgit Malaysia. Messiniaga Berhad was once a business that sold IBM office supplies, is today a provider of multi-platform technological solutions. Messiniaga has launched 7 products which are My Mom's, Tube, NetSiska, MB Cloud, MB Hybrid, MB Evergreen and Loft.
PDZ Holdings Berhad was incorporated in 1995 and became a public listed company in 1996. The main activity of this organization is ownership and operations of seagoing vessels, shipping agency, and ship management activities.
Besides that, I will present about MFRS 108 Change in Accounting Policy Estimate and Error for Company Oli Corporation Berhad. So, here we got some example of disclosure of MFRS 108 Change in Accounting Policy in this company. The adoption of the amendments to MFRS did not affect the financial statement in this company. Also, the amendments update MFRS 3 by replacing a reference to an old version of the conceptual framework for financial reporting, which refers to the latest version which was issued by MASB. The latest update of MFRS is annual improvement to MFRS Standard 2080 to 2020. Amendments to MFRS 30 Business Combination, MFRS 10 Consolidated Financial Statement, MFRS 128 Investment in Associates and Joint Venture, and amendments to MFRS 101 Presentation of Financial Statement. Lastly, no resulting change and material effect on financial statement for year 2020 and 2021.
In 2020, the new MFRS was adopted, which is MFRS 16, COVID-19 related rent sanction on 1 June 2020. It changed from classified as operating lease under MFRS 117 to MFRS 16. The adoption of MFRS 16 hasn't had a material impact on the total comprehensive income and the cash flows of the group. There is no reconciliation of equity, total comprehensive income, and statement of cash flows for the year ended 30 June 2019. In 2021, according to MFRS 108, the change in accounting policy of Harbour Link Group Berhad has been accounted for retrospectively. The scope of MFRS 9 Financial Instrument Recognition and Measurement contingent consideration classified as an asset or liability is measured at fair value with changes in fair value recognized in the statement of profit or loss correspondingly with MFRS 9.
There are 4 standards amendments to published standards and interpretation that are effective for the groups and the company's financial year beginning 1st January 2020. There are other amendments that are not yet effective for the financial year, but I'll present about the effective one. So the first one is Conceptual Framework for Financial Reporting Revised 2018. The second is Amendments to MFRS 101 and MFRS 108, Definition of Material. Amendments to MFRS 3, Definition of Business. And the last one is Amendments to MFRS 9, MFRS 139, and MFRS 7, Interest Rate Benchmark Reform. So, for the amendments to MFRS 3, Definition of a Business, Amendments to MFRS 3 Definition of a Business revised the definition of a business. To be considered a business, an acquisition would have to include an input and a substantive process that together significantly contribute to the ability to create outputs. The amendments provide guidance to determine whether an input and a substantive process are present, including situations where an acquisition does not have outputs. In addition, the revised definition of the term output is narrower, focuses on goods or services provided to the customers, generating investment returns and other income but exclude returns in the form of cost saving. The amendments introduce an optional simplified assessment known as concentration test that, if met, eliminates the need for further assessment. The assets required would not represent a business when substantially all of the fair value of gross assets required is concentrated in a single identifiable assets or a group of similar assets. So the group has applied the amendments prospectively to transactions for which in the acquisition date is on or after 1st January 2020. There is no acquisition during the financial year. Amendments to MFRS 9, MFRS 139, and MFRS 7 Interest Rate Benchmark Reform provide temporary relief from applying specific hedge accounting requirements to hedging relationships directly affected by interbank offered rate reform. The reliefs have the effect that IBOR reform should not generally cause hedge accounting to terminate. However, any hedge ineffectiveness continue to be recorded in the statement of comprehensive income. The reliefs will cease to apply when new uncertainty arising from interest rate benchmark reform is no longer present. So in accordance with the transition provisions, the group and company have adopted the amendments to MFRS 9 and MFRS 7 respectively to hedging relationships that existed at the start of the reporting period or were designated thereafter, and to the amount accumulated in the cash flow hedge reserve at that date. These amendments had no impact on the amounts recognized in the current prior period. For the amendments that are effective for the group's company and the company's financial beginning on 1st January 2021 are amendments to MFRS COVID-19 related rent concessions and amendments to MFRS 9, MFRS 7 and MFRS 16 Interest Rate Benchmark Reform Phase 2. And the adoption of the above amendments have no significant impact to the group and the company.
In PDZ, there are no changes in accounting policy, estimates and error, but there are some amendments that was added at the beginning of the year 2020 and 2021. Therefore, the amendments have no effect on the amounts recognized in prior periods, and they are expected to have no effect on the current and future periods of the consolidated and separate financial statements.
Now, I will present about MFRS 116 Property, Plant and Equipment. So, this company using cost model for the sequence measurement and straight line method on depreciate the property, plant and equipment. This company depreciate building 2%, electrical installation 10%, plant and machinery and motor vehicle 50%. Next, this company depreciate office equipment, furniture and fitting also renovation as much as 10%.
According to MFRS 116, property, plant and equipment in 2020 and 2021, the company is using cost model method. Under the cost model, the carrying amount of PPE is measured at its cost less any accumulated depreciation and any accumulated impairment losses. Assets under construction included in PPE are not depreciated as these assets are not yet available for use.
Mesin niaga property, plant and equipment initially stated at cost. The cost of an item of property, plant and equipment initially recognized includes its purchase price or any cost that is directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. Cost also includes borrowing costs that are directly attributable to the acquisition, construction or production of a qualifying asset. So subsequent costs are included in the asset's carrying amount or recognized as a separate asset as appropriate only when it is probably that future economic benefits associated with the item will flow to the group and the cost of the item can be measured reliably. The carrying amount of the replaced part is derecognized. All other repairs and maintenance are recognized as expenses in profit or loss during the financial period in which they are incurred. Gain or losses on disposals are determined by comparing proceeds with carrying amount and are included in profit or loss. So, other property, plant and equipment are depreciated on the straight line method to allocate the cost of the revalued amounts to their residual values over their estimated useful life at the following annual rates: building 2%, machines 14% to 33%, office equipment, furniture and fittings 7% and 33%, motor vehicle 25%. This annual rate applied to 2020 and 2021. At the end of the reporting period, the group assesses whether there is any indication of impairment. If such indication exists, an analysis is performed to assess whether the carrying amount of the asset is fully recoverable. A write-down is made if the carrying amount exceeds the recoverable amount. That's all.
All items of PPE in PDZ are recorded at cost and measured at cost less accumulated depreciation and accumulated impairment losses. For the depreciation, PDZ used the straight line method, and these are the annual rates used to calculate the depreciation.
Next is MFRS 133 impairment. The carrying amount of the asset is more than the recoverable amount. When there is a change in the estimate used to determine the asset recoverable amount since the last impairment was recognized, it is impairment loss. No impairment loss is recognized for asset in previous years. If the reversal of the impairment loss in the limited of the amount of asset that have been determined, the reversal is recognized in profit or loss. In this company, no impairment loss or reversal of impairment loss for 2020 and 2021.
According to MFRS 136, impairment of assets, during the economic life of a long-lived asset, there may be a situation where the carrying amount of the asset is more than the market value. Impairment of an asset occurs when the company is unable to recover the asset's carrying value through use or sale. In 2020, the impairment losses on PPE was 8.3 million and in 2021 is 1.70 million. There is no reversal in 2020 and 2021.
Impairment of non-financial assets for Mesin Niaga Berhad assets that have indefinite useful life, for example, intangible assets, not ready to use, not subject to amortization, and are not tested annually for impairment. Assets that are subject to amortization are reviewed for impairment whenever events or changes in circumstances indicate that the carrying amount may not be recoverable. An impairment loss is recognized for the amount by which the carrying amount of the asset exceeds its recoverable amount. And the group and company assess on a forward-looking basis the expected credit losses associated with its debt instrument carried at amortized cost. The impairment methodology applied depends on whether there has been a significant increase in credit risk. The group and company have 4 types of financial instruments that are subjected to the expected credit loss, which is ECL model. The first one is trade and other receivables, loans to subsidiaries and amount due from subsidiaries, amount due from a related party, and contract assets. While cash and cash equivalents are also subject to the impairment requirements of MFRS 9. The identified impairment loss was immaterial. So the measurement of ECL actually reflects an unbiased and probability weighted amount that is determined by evaluating a range of possible outcomes. The time value of money, and the last one is reasonable and supportable information that is available without undue cost or effort at the reporting date about past events, current conditions, and forecast of future economic condition. For trade receivables and contract assets, the group and company apply the simplified approach, which requires expected lifetime losses to be recognized from initial recognition of the receivables.
Assets with indefinite useful life in PDZ are not subjected to amortization and are tested annually for impairment. To assess the impairment, assets are grouped at the lowest level for which there are separately identifiable cash flows. Meanwhile, the impairment losses on goodwill are not reversed.
We go to next part, which is financial statement analysis. Return on asset for this company is increased from 1.02% in 2020 and 11.17% in 2021. We can conclude this company, their net income is increased and average total asset are decreased because the return on asset is increased from 2020 to 2021. Next is current ratio. Current ratio of Uli Corporation Berhad is fall dramatically from 4.78 times in 2020 and 4.36 in 2021. It can be concluded that this company have a difficult time paying their debt and liabilities. Lastly, equity ratio. The debt of equity ratio in 2020 is 0.84 fall to 0.82 in 2021. We can conclude in 2020 is more effectively with a minimal amount of debt than 2021.
Return on asset in 2020 is 3.51% and in 2021 is 10.19%. This shows that this company was getting better as the percentage in 2021 was increasing more than 5% than before. Current ratio in 2020 is 2.58 times and 2021 is 3.10 times. This shows that current ratio in 2021 was better as the company has more current assets than liabilities to cover its debts. Lastly, equity ratio in 2020 is 0.71 and in 2021 is 0.75. The company is considered better as it was increasing from 2020 to 2021. A higher equity ratio seems more trustworthy to investors.
The return on assets ratio for Messina Berhad on 2021 is higher than in the financial year 2020, which is 2.7% and 3.8% respectively. This indicates that the company produced relatively higher earnings in comparison to its asset base including more capital efficiency in 2021. Next, the current ratio for Messianiaga Berhad in 2020 is higher than 2021. This shows that Messianiaga Berhad are more capable of paying off their debts in 2020 than 2021. Last but not least, the equity ratio for 2020 is higher than 2021, which are 0.61 in 2020 and 0.51 in 2021.
PDZ Financial Statement Analysis. The return on asset in 2021 and 2020 are negative 3.56% and negative 18.14%. For every 1 ringgit of asset in 2021, the company generates 3.56 cents losses. The current ratio in 2021 and 2020 are 3.04 and 1.26. The company's liquidity became higher, which means that they have more assets to pay off the debts. Lastly, the equity ratio in 2021 and 2020 are 0.56 and 0.18.
Next, key audit matter. In this company, we have determined that there are no key audit matter to communicate in our report arising from the audit of the company financial statement. This key audit matter based on the matter communicate with the director. We determine this company don't have a key audit matter because the adverse consequence of doing so would reasonably be expected to outweigh the public interest benefit of doing so.
For key audit matter in 2020 and 2021, Harbour Link Group Berhad has performed the following procedure to address this area of audit focus. The first one is assess the reasonableness of historical loss rate applied. Then, understand and discuss the forward-looking information gathered by the management in relation to the provision metrics and the application thereof.
The audit focus on this area as there are judgment involved in arriving at the quantum and timing of revenue recognized. Judgment is exercised in determining the number of distinct performance obligations included within these contracts with customers. Allocation of transaction price to the identified performance obligations based on the standalone styling price. Judgment is exercised in determining the appropriate estimation of costs and in anticipating the timing between recognition of revenue and billings to the customers, which may subsequently change due to specific risks and performance of the actual contract terms.
The first key audit matters in 2020 for PDZ is the revenue recognition. It is due to risk that revenue may be overstated from the perspective of timing of recognition and the amount of revenue recognized. The second key audit matters in 2020 is the recoverability of trade receivables. The impairment losses on trade receivable may be understated and hence impairment losses may be required. The key audit matter in 2021 is also the recoverability of trade receivables. The allowance expected credit losses on trade receivable may be understated and hence allowance of expected credit losses may be required.